As of today, Sunday, June 21st, 2026, the stock market is officially closed for the weekend, following a holiday-shortened trading week where the market was also closed on Friday, June 19th in observance of the Juneteenth holiday. Therefore, the latest official market data comes from the close of regular trading on Thursday, June 18th, 2026 at 4 p.m. Eastern Daylight Time, when Aditxt Inc., trading under the ticker symbol ADTX on the Nasdaq Capital Market, recorded a closing price of exactly $0.0100 per share. This represents a massive intraday surge of 127.27% from its previous closing price of $0.0044, with the equity wildly fluctuating between a daily low of $0.0090 and a daily high of $0.0180 during that singular explosive session. While a triple-digit gain usually sends retail traders into a frenzy on major social platforms looking for the next retail short squeeze to match the historic runs seen in legacy tech giants, the hidden reality under the hood paints a completely different picture. The sheer volume on Thursday reached an astronomical 5.38 billion shares traded, which is completely unprecedented for a microcap company whose total market capitalization sat at less than $10,000 prior to this volume explosion. But here is the critical twist that most momentum traders overlooked while chasing the ticker on their smartphone screens. At the exact moment retail investors were pile-driving cash into the asset, new regulatory filings showed that major institutional block holders were aggressively dumping their entire positions. Specifically, securities disclosures revealed that HRT Financial, which had been documented as a major holder of the company, liquidated more than 3.13 million shares at an average price of $0.0130, leaving them with zero direct stakes. Simultaneously, DRW Securities moved their remaining blocks, liquidating their position completely into the retail buying frenzy. This massive institutional exit shows that while retail traders viewed the penny surge as a launching pad, institutional risk algorithms viewed the liquidity spike as an emergency exit door. The standard expectation among small-cap momentum chasers who utilize mainstream platforms like the Robinhood app or SoFi Invest is that a stock trading at 1 penny with billions of shares in volume is primed for an epic short squeeze that could return hundreds% in a matter of days. Investors look at historical charts and hope for a repeat of massive microcap rallies where beaten-down biotech equities suddenly catch fire due to a sudden retail consensus. People trading on online investment platforms often assume that massive volume equals institutional accumulation. The reality, however, is far more sobering when you look closely at the corporate structure and the mechanics of extreme share dilution. When a stock falls into the sub-penny fraction territory, its trading dynamics become entirely uncoupled from fundamental business valuations and turn into a pure mathematical game of fractional distribution. The broader market narrative says this is a classic oversold turnaround play, but the contrarian reality is that the company is caught in a severe capital death spiral where heavy debt restructuring and continuous equity issuance are the only mechanisms keeping the lights on. To understand how Aditxt arrived at this extreme position, we have to look closely at its recent trading metrics, institutional positioning, and the intense macroeconomic pressures facing microcap biotech entities in 2026. The capital market environment this year has been unforgiving to companies lacking clear cash flows. Even though major institutional investment tools like Schwab Intelligent Portfolios or a Standard Fidelity brokerage account have directed vast amounts of capital into stable mega-cap equity assets like Nvidia stock, Apple stock, or Tesla stock, high-risk microcaps have faced a severe liquidity drought. This macro pressure has forced companies like Aditxt to rely on highly dilutive financing facilities. The 5.38 billion shares that changed hands in a single Thursday session demonstrate a level of share turnover that is mathematically impossible without massive continuous share creation. When a company continually issues new shares to satisfy debt notes or raise quick operational capital, the existing share base expands dramatically, pushing the individual share price down to fractions of a cent. For anyone managing a self-investing account or an individual brokerage portfolio, seeing a share base balloon into the billions while the market cap shrinks to near zero is the ultimate structural red flag, regardless of how enticing a one-day triple-digit percentage move might look on a simple daily chart. This disconnect between price momentum and core financial health is exactly why choosing the right interactive brokers platform or analyzing deep regulatory documents is vital before making an online investment commitment. If we step back and look at what Aditxt actually does, the business model centers on life sciences and biotech innovations, specifically focused on developing platforms for monitoring and modulating the human immune system. Their intellectual property includes concepts like Aditxt Score, which was designed to provide a comprehensive profile of an individual's immune system health, allowing for personalized medical insights. They have also attempted to expand their corporate footprint through various acquisitions and commercial agreements, such as their heavily discussed deal involving Ignite Proteomics, aimed at broadening their technological capabilities in protein analysis and diagnostics. In a healthier corporate framework, these diagnostic platforms would generate predictable commercial revenues through clinical partnerships and medical laboratory networks. However, the history of microcap biotech is littered with companies that possess interesting laboratory concepts but utterly fail to navigate the extremely expensive path of commercialization, regulatory compliance, and scalable marketing. Looking at older financial statements and past corporate reports reveals a multi-year trend of severe operational deficits that directly explains the current penny stock status. Over the last several years, the company's operating profit margins have settled into negative territories that exceed several thousand% relative to their actual top-line revenue. For instance, audited financial data from past fiscal periods showed annual revenues hovering at minimal levels, while net losses consistently ran into tens of millions of dollars due to high research expenditures, executive compensation, and financing fees. This chronic imbalance meant that the firm had to repeatedly execute reverse stock splits just to keep their share price above the $1 minimum required to maintain its listing on the Nasdaq exchange. Each reverse split temporarily consolidated the share count and artificially boosted the stock price, only for subsequent dilutive share issuances to drag the price right back down to the fractions of a penny we see today. Investors reviewing these metrics on popular investing sites can see a clear pattern where long-term shareholders have faced near total capital destruction across multiple corporate reorganizations. This brings us back to the crucial framework of expectation versus reality when analyzing the future outlook for Aditxt. The short-term expectation held by speculative day traders utilizing the Robinhood trading platform or engaging in active self-investing is that the company might secure a sudden partnership, receive a massive cash injection, or finalize its pending acquisition agreements in a way that fundamentally changes its capital structure. Speculators are betting that the massive volume witnessed just before the holiday weekend indicates that a major market maker or a new consortium of private equity investors is quietly building a massive position to take the company private or mount a serious corporate turnaround. In this optimistic scenario, any positive corporate announcement dropped on a Monday morning could trap short sellers and spark a massive continuation of Thursday's 127% rally, turning a tiny investment into a significant windfall. However, the structural reality suggests a highly dangerous downside scenario that could culminate in a total loss of capital for anyone holding the asset in a standard Fidelity trading platform or interactive broker's account. The most pressing operational catalyst is the company's non-compliance with Nasdaq listing requirements. Exchanges have strict rules regarding prolonged trading below certain price thresholds, and a company whose shares are valued at a single penny is in imminent danger of being delisted to the over-the-counter bulletin boards. If a delisting occurs, the stock loses access to mainstream institutional liquidity pools, meaning that major wealth management platforms, automated portfolios like the SoFi robo-advisor, and institutional index funds will completely bar the asset from their platforms. Furthermore, the insider selling documented from HRT Financial and DRW Securities shows that the very institutions that understand their corporate restructuring agreements best are choosing to exit their positions entirely rather than writing out a potential turnaround. This indicates that the massive trading volume was likely driven by institutional high-frequency algorithms clearing out old inventory and passing the remaining float directly into retail accounts. Comment below how many shares of Aditxt Inc. you currently hold in your portfolio, or if you are entirely avoiding microcap biotechs in the current economic environment. Hearing your perspective on these ultra-low-priced equities helps gauge exactly how much retail appetite remains for these hyper-speculative plays when megacaps are dominating the broader indexes. When evaluating these options on advanced software like the Interactive Brokers Trading Platform, or looking for investment help through established channels like Fidelity Wealth Management, the ultimate takeaway is that retail expectations are continuously colliding with severe institutional realities. The expectation is a classic basement valuation turnaround, a lottery ticket that could pay off handsomely if the immune monitoring technology suddenly finds a massive commercial foothold or an acquisition lands perfectly. The reality is a corporate entity burdened by massive historical debt, relentless share dilution that erodes individual equity value almost daily, and professional institutional investors actively using retail rallies to liquidate their positions to zero. For a disciplined investor utilizing tools ranging from the Fidelity mobile app to dedicated SoFi investing accounts, the data shows that chasing short-term percentage spikes in companies with deeply compromised balance sheets carries structural risks that far outweigh the speculative rewards. Navigating these highly volatile waters requires a brutal adherence to corporate data over market hype, ensuring that your capital is backed by authentic revenue generation rather than speculative fractional trading volume. Disclaimer. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Bags and stats. Don't forget to like, comment, and share this video to support the channel.